Okay. Hello, everybody. Welcome to today's podcast, Just Say No, a podcast for nonprofits about accepting and acknowledging year-end gifts. My name is Jason Q. I'm a staff attorney at the DC Bar Pro Bono Center. Today's recording is part of our monthly podcast series co-sponsored by the Center for Nonprofit Advancement, focusing on the practical challenges and legal questions that nonprofits encounter on a regular basis. On the Pro Bono Center's website, you can find our entire collection of webinars, newsletters, legal alerts, and other resources covering a wide range of nonprofit legal issues. That website is lawhelp.org/DC/CED. So we're talking today about the responsibilities that nonprofits have when it comes to accepting and acknowledging charitable contributions and some potential pitfalls that they should look out for. Joining me is Regina Hopkins, Assistant Director of the DC Bar Pro Bono Center. Regina oversees our nonprofit and small business legal assistance programs and is an expert on the laws relating to tax-exempt organizations. Before joining the Pro Bono Center, Regina worked as a tax attorney in private practice and then joined Habitat for Humanity International, where she served as Vice President and General Counsel. Hi, Regina.
Hi, Jason. How are you?
Great. So it's December. We're coming into the holiday season and nearing the end of the calendar year. Why is now a particularly good time for nonprofits to think about the way they accept and acknowledge their charitable contributions?
Well, the end of the year is a big time for giving. When I was at Habitat for Humanity, for example, 40% of our income came between Thanksgiving and New Year's Eve. Individuals in particular give a lot of gifts at the end of the year, but so do corporations sometimes, and you'll have foundations or others who have money at the end of the year and they want to get it out to nonprofit organizations. So it's a big giving time, and there are also a lot of events that people do. They do silent auctions. They may have events in connection with Christmas parties and the like to benefit nonprofit organizations. So there's just a lot of money that goes around this time of year.
Great, and I think a lot of those contributions are going to come in the form of cash contributions. I think that's a straightforward type to receive.
Right. The most common, large bulk of donations are cash, and in many ways they are the easiest to deal with. I mean, you get cash. You just put it in the bank, and it's great. So there are a couple of issues that do come up with cash, though. The first is, do you have to provide a receipt? As a nonprofit, you have to provide a receipt to the individual. We'll talk a little bit about that later. But the other thing to do is when do you book the contribution, in effect? For the individual, that can be very important. Particularly now with potential changes in the tax law that may affect how much you can deduct for charitable contributions. The timing of the contribution may be very important. And the rule generally is, for all contributions, whether cash or any other form, is when does it leave with the donor? Not when it's received by the organization, but when does the donor part company with it? Okay. And in the case of cash, that it could be when they mail the check. They put the check in the mail, and it's in the mailbox beyond their retrieval, or when they hit the process button on the credit card donation. Those are all situations where you've done everything. You can't call the contribution back, and so at that point, that's when you do it. Some charities have conventions that they follow. So let's say you get a bunch of, and it's not uncommon to get. So January 2nd comes. Yeah. You open your mail, and there's checks, and it's all checks that people may have mailed on the December 30th or 31st, or they may have gone onto your website over that last weekend of the year and made contributions. So when do you count them? And what you can do with a lot of nonprofits do is they say any checks received in the first day or two of the new year is treated as a 2017 contribution.
Got it.
And then after a certain point, like say maybe it's the 4th or the 5th, anything received at that point or later is treated as a 2018 contribution. And then just for 1 or 2 days, you'll actually look at the envelope to see when it was postmarked. And then also you'll see when the credit card transaction was initiated, not when you got the money. And as I said, the timing of the contribution may be very important to the donor.
especially this year, a lot of donors might be particularly sensitive to making sure that their contributions are counted for 2017 instead of 2018.
Yeah, under the proposed tax legislation, we don't know when it's going to be adopted and what the effective date is, but it will probably be the 2018 tax year. What they're going to do is they're not going to abolish the charitable deduction, but in order to claim a charitable deduction fully, what you have to do is you have to itemize your deductions. You can't take the standard deduction. And there's two things that are going to happen that could potentially impact how many people itemize. Currently, about a third of the taxpayers itemize. The big drivers of itemization are you want to deduct your mortgage interest and your local and state taxes. What the tax legislation is thinking of doing is limiting the mortgage interest deduction and eliminating the deduction for local and state taxes. So that would essentially take a lot of people out of itemization. Coupled with that is they will probably increase significantly the standard deduction. So currently it's going to double to $12,000 individual and $24,000 per couple. And the result of which is that they estimate maybe only 5% of taxpayers would itemize after the change in the law. And so, you know, for people who are thinking of making a contribution around this time of year, they may want to do it in 2017 when they can get the value of the deduction, rather than risk that they won't be able to in 2018. And we may actually know that before the end of the year if they pass the legislation before Christmas.
Got it. Okay, so we talked about the checks in the mail situation where you open your mailbox in the new year. If people are using online donation platforms, the exercise should be not just, you know, whenever you see that the money's come through, but to do a little bit of peeking behind the curtains and trying to figure out when the actual donation was made.
Exactly.
Right.
Then the other thing, and oftentimes if you have it set up so that there's an automatic receipt or something like that, that will essentially put the donation in.
Okay. Great. So that's cash contributions, but then there's this whole other category of contributions, non-cash contributions, and nonprofits might be able to expect more of these at the end of the year, or?
Yeah. Particularly, you might see more stock donations, particularly this year, because of the rise in the stock market. There are some beneficial tax treatments to charitable contributions of stock. We won't get into the rules, but basically it has to do with you can deduct the value of the stock, not how much you paid for it, so you get the benefit of the appreciation without having to be taxed on it. Publicly traded stock is almost like cash, in that there is an easily established market value for the stock. It's generally speaking, what you do is the day that the stock is donated, you take the average of the low and the high price for the day, and that's how you value the donation. So someone gives you 10 shares of Acme Company stock, and it's the trading range on that day is 48 to 52. Then it's going to be $50, which is the average of those two numbers, and times 10 is $500. So that's pretty easy math. And this is true of anything that's publicly traded on an exchange, whether it's bonds or treasury notes or anything where there's an easily established market value. Some of the rules are a little bit different as to valuation depending on the type of instrument, but basically that's the rule. Is you take what is listed, what the sale price is on the day that it's transferred. And transfer in this context generally means the date that the order is given to the broker to send the stock. That it starts the transfer process, and it cannot be called back. Again, the idea is it's left to your control, and it's less about when the donee organization receives it as to when it leaves your hands.
Leaves the donor's hands.
Yes. Yeah. Now, one thing that stock is great, and we're going to talk a little bit more about gift acceptance policies. But one of the things that you should have in hand, or thought about in advance of the end of the year, or if you haven't done it yet, maybe do something going forward, is a policy about what you're going to do with stock that is donated to you. When we were in Habitat for Humanity, we had a policy that stock was sold immediately. We didn't hold and invest in stock. We sold it immediately and converted it to cash. And sometimes it may take a day or two to turn around, and if the stock went up during that day or two, that's great, but it doesn't impact the amount of the deduction that the donor gets to make because theirs was fixed on the date of transfer.
Got it. And then for non-publicly traded stock?
Non-publicly traded stock, there are some, it's more difficult to value, obviously, because there's not an external market. You have to try to estimate what the stock is worth. And there are some valuation conventions that accountants or investment bankers use. The real issue with non-publicly traded stock is you probably can't sell it. It looks good. You have 100 shares of the My Private Company stock, Inc. stock, but you can't realize cash. Now, there's probably not going to be a downside to taking that stock and just holding on, because you never know, that company could go public at some point. They could have an IPO and you could realize the cash. But it's something you may want to talk to your attorney about before you take that. Again, unlike some other properties where there's potential liability for accepting it, there's a whole lot less with stock because it's just shares in a corporation. But it may not have much help to you. So
something to think about maybe at a policy level, again, whether your organization is going to accept non-public traded stock, whether they want to hold on to it and think about it.
Yeah, just stick it in a file drawer somewhere and hope that someday it turns into money.
Got it. So another very tricky category can be gifts of land.
Land can be very tricky. There's a couple of reasons for that. One, accepting and owning land is not necessarily, even free land is not necessarily free. For starters, there's property taxes and assessments that could go against the land. There's upkeep and maintenance in a lot of places. You have to maintain the property, particularly if there's a structure on it, so that it's safe. If you let weeds overgrow your lot, sometimes the city or town will come in and mow the lawn and charge you for it, and things like that. And the big and kind of potentially scary part is if there was hazardous waste on the land. Someone gives you a piece of land and there's hazardous waste in it. If you own that land, even if you subsequently sell it, if you've ever owned it, you may be liable along with the other owners in the chain of title to clean up the property. So let's suppose you buy the land is polluted in 1995 and you get title to it in 2017. You may still be liable for part of the cleanup costs of that land if it's subsequently determined to have hazardous waste on it in 2025. So there's a potential liability there that you have to think about.
Right.
So, and then the other thing is it may not be able to sell the land.
Or to use it the way that you were intending to.
Yes, it may be zoned for commercial and you would want it for residential. It may be, we used to get land donations all the time, and sometimes you could build on it, but you'd have to put a road in, or you'd have to link the utilities, or you could there was a 2-acre lot minimum, or something like that, so it was a non-buildable lot. And so there were a lot of restrictions on the use of land in terms of zoning and setback requirements, septic systems and waste treatment, accessibility and things that could make it that even if you could build on the land, it would be expensive to get to that stage. And so what you would want to do is not accept land until you really studied it. That includes doing an environmental assessment to see whether there's a risk of hazardous contamination on the land and whether or not it's usable and sellable. And one of the questions I used to ask was, has this land been on the market, and if so, how long? And sometimes people would say, yes, it's been on the market for 2 years. Well, that's your first clue that maybe this isn't the greatest donation in the world. The donor may be just trying to salvage something out of this property, like maybe a charitable deduction, when in fact it's not necessarily something that you would use.
And that's sort of the kind of background issue lurking in a lot of these issues with the non-cash transfers, especially at the end of the year. It's, we assume the donors always have our best interest at heart, but some of these things that are being donated, it might just be because it's otherwise hard to kind of realize some value out of that item.
Yeah, and maybe that and collectibles and used furniture or other things that that the donor needs to dispose of, and and they thought, well, I'll give it away and maybe I'll get something out of it. And in fact, it may not have very much, if any, value to the organization, and in fact may be more expensive to dispose of than to use. So this is a case where a gift acceptance policy is really good, because so someone calls you up on December 27th and they say, I have a piece of land, it's worth $300,000. But my donor has to donate it by the end of the year.
Right, because they want that 2017.
They want the 2017 deduction, whatever. And so you're under a lot of time pressure. And the temptation to say yes, because it's a lot of money, is very strong. And it's helpful to have policies in place so that that sort of buck you up to say, you cannot accept a land donation unless you had an environmental assessment, unless you've done a title search, unless you've looked at the zoning and a checklist, a due diligence checklist. And only if that's been done can you accept a donation of land. The fact that you may not be able to do that in time is often gives people the strength they need to say no. Right. And it's also true of office equipment or computer equipment or something like that.
Appliances.
I was talking about, I donated, my husband and I remodeled our kitchen, and I donated our washer and dryer to an organization, and they had a policy that the appliance had to be less than 10 years old and in good working order, and that's the conditions. So we had to look on it, and see, there was a serial date with the date of manufacture on it, and the like, and then they would take it. But that was their rules, and it helped them avoid accepting a lot of bad donations.
Right. So, these tangible items are probably something that nonprofits might see more often than land or than stock, and so it's still a good idea to think about them sort of at a policy level and think, maybe it's good for us to take in used computers, for example, but maybe we should have some criteria for the condition that the computers have to be in.
Or they have to be within less than 3 years old or something like that, because a lot of people, particularly, they'll get a new computer at Christmas, and what do they do with their old one? And so they may say, I'll donate it. Or companies sometimes will donate. Used computer equipment is a big thing that people donate, and it may not necessarily be useful to you. And if you have clients who might be able to use it, that's fine. But if you know up front that you're only going to accept these types of computers for these types of purposes, then that's what you do. And so it just saves you from making some bad choices.
Yeah, or to scramble to make a choice at the very end of the year and figure out what your policy is.
Exactly.
Got it. Okay, well, that's great. So gift acceptance policy is definitely something to think about. So let's go back to something we mentioned at the beginning, which is whether it's a cash donation or a non-cash donation, what is the nonprofit's responsibility when it comes to acknowledging or receiving that kind of contribution?
Okay, well, this is a case where cash versus non-cash is really important. You can always acknowledge a cash donation. Thank you for your check of $100 or your contribution of $100. That's fine. But what you should not ever do is put a value on donated property, even stock, because it's the donor's responsibility, and the law is clear on this, the donor's responsibility to value in-kind donations. And the IRS has rules for it. For publicly traded stock, they have rules. For gifts of smaller gifts of property, they have rules, and for larger gifts like land, where they have to have a qualified appraisal by someone who meets the IRS requirements for being a qualified appraiser. And sometimes they'll ask you, the donor will say, well, can you put it $300 for the computer equipment or something like that? Do not ever do that.
I've actually seen, gift acceptance forms that have a little field in it where the nonprofit is supposed to write down how much the donated property is worth, and that's a bad idea.
It's a no-no. It's not going to work for the donor. For the IRS, as far as the IRS is concerned, it's like wasted. And then there's a real risk that the IRS will come back and say, what are you doing to substantiate or providing a receipt for something that isn't really worth what you say it is.
You don't want to get into a fight with the IRS over how much you said this thing was worth.
Exactly.
If there's some sort of discrepancy or disagreement.
For a while there were cars. It was very popular to donate cars to nonprofits, and people were taking somewhat inflated values for the cars. And so the IRS, specifically in that area, cracked down and said, look, it's the Blue Book value, and the donor had a special form to fill out, and it's not the charitable organization. So a nice acknowledgement. Thank you for your donation of 5 computers, HP whatever computers. We appreciate it very much. Be very kind and thoughtful and acknowledging it, but don't put a value on it. Similarly, it's important for people to know that services, even if I'm a professional, I'm a lawyer or an accountant, I donate services to a nonprofit, those are actually not deductible. The rules are clear, and they've been clear for decades, that a donation of services is never deductible by the donor. And that includes use of office space or whatever. And so write a very profuse thank you note, because that's all they're getting is the thank you. They're not getting a deduction. There are a couple other rules that the IRS wants. The first is, if someone gets something in return for the donation, the charity has to tell the donor, give them a good faith estimate of what the fair market value is. Like, say you have a silent auction. Okay. And you're auctioning off 2 basketball tickets worth $150 each, or $300. And that person bids on it, and they bid $200, and they pay $200, and they get the basketball tickets. That's great for you as the donor. You have $200. I mean, as the organization, you have $200. It's great for the person who bought the tickets. They got a bargain. They got $300 worth of tickets for $200. And it's great for the person who donated the tickets, because they're worth $300. They get a $300 deduction. The person who bought the tickets, however, does not get a deduction. That $200 is not a deductible. It is not a contribution, because they got more in value for their money than they put forward. They gave $200. They got something worth $300 in return. So there's no donation there. So the only donation would be as if they bid $400 for the tickets, and they would get the $100 deduction. But you always have to subtract the value.
And the way the IRS would figure this out is because nonprofits are required to provide a little statement saying, hey, the fair market value was this, and the donor paid this.
Yeah, sometimes it's easy. I mean, it's a gift card, or it may be a gift card, or it may be tickets or something. Sometimes it's a little harder because it's something like it may be a dinner or something, but you still have to give a fair market value for the dinner.
So if you had $100 for a gala dinner, you would have to disclose to the donor that you paid $100 for the dinner, but the fair market value of the food was X amount.
$60, so your $40 is deductible. Right. Now, the other thing is, if someone gives a cash or any type of donation and gets nothing like that in return, the donors of the organization should say no goods or services were given in return. And that's especially important for larger donations. The person making the deduction always has to substantiate it. They have to prove that they wrote the check, or donated through a credit card, or did something like donated property. Now, if it's a check or credit card and the donation was less than $250, that check or credit card receipt is sufficient proof. Property, you always have to get some acknowledgement from the nonprofit. But for cash or credit card donations in excess of $250 or more, they actually have to get an acknowledgement from the nonprofit saying that they got the money and this is the date they got the money on. And it has to say whether or not there were goods or services provided. And so the receipt would say, Jason gave $250, thank you, Jason, on December 30th. No goods or services were provided in exchange for this donation. So that's your proof that you can deduct it. And if the donor does not have that receipt, they actually cannot claim the deduction.
Great. So that's a good tip for nonprofits who are writing acknowledgements, is to include that little sentence there, because that'll make the donor's life a lot easier.
Well, it will make it deductible, because there have actually been cases where the organization forgot to put that little line in there, that no goods or services, and the courts have denied them their deduction. So it can be very punitive if you make the mistake. Now, the person needs those acknowledgements in hand at the time they filed their taxes. So a lot of nonprofits now have gotten into the practice, just like you get your W-2 or your mortgage interest statement or something else, you get a letter from the charity saying, thank you, in 2017, you donated the following amount on the following days, and whether no goods or services were provided or whether there was, and so they'll give you essentially a year-end summary of your donations, so that you have that letter in hand when you file your tax returns. You don't have to attach it to your tax returns, but you have to have it if you're ever audited.
Okay. And
so you keep that for your records. And like I said, a lot of nonprofits have gotten, like you give money to NPR or WAMU or something like that, you will actually get a year-end summary of all your contributions during the year.
So that's another practice that maybe nonprofits should think about, because donors might be starting to get into the habit of receiving those January statements and might be expecting them.
Yes, and like I said, it just makes it easier rather than having them keep track of like 6 or 7 different receipts if you give them a year-end summary.
Okay, that's a great tip. Fantastic. So year-end summaries, a good practice. Gift receipt policies, something to think about.
Right.
Yeah.
And that's it. And like I said, it is, we really need the support of our donors, our particularly individual donors, who often are the most loyal and reliable donors. Sometimes when the economy goes down or something, you may lose some money on your government grants. Some of your corporate donors may tighten the belt, but individual donors are actually, particularly in tough economic times, the most faithful, loyal donors. Oftentimes they'll actually, if they're in a position to do so, they'll increase their donations because they realize that they have something and other people are in need. So you try to do things in a way that sort of helps them and makes the donation process as painless as possible. And then the other thing is, as I said, is just think about, in the first of the year, this is something you can do, maybe at some time later on in the year, is think about your donation practices. Sometimes one thing we didn't talk about, but also comes into play at the end of the year, is are there any types of organizations you would not accept a donation from? I know Mothers Against Drunk Driving, for example, will not take donations from liquor companies. So if you have any principles, like you don't want to accept defense contractors or liquor companies or cigarettes or something like that, it's good to, again, have those discussions in advance rather than having them on December 27th. And someone says, I want to give you 100 shares of, Budweiser stock. And you're like, is that consistent with our values? And so if you have those discussions in advance, then you don't have the pressure of trying to say yes or no. And so that's another thing you might want to incorporate into a good gift acceptance policy. Is there any sort of philosophical type of restrictions on what you want to take?
And having those discussions in advance will make it less personal. It'll make it really more about the principles and not like, oh, I'm looking at this contribution from this specific company or specific individual. It'll make it.
And and it's done in the abstract rather than, oh, I didn't make my fundraising goal for this year. Oh my gosh, we're not going to be able to buy those new computers. And just the pressure of the circumstances is you don't have to think about it as much.
Great. Well, thanks for talking, Regina. This was great.
Well, thank you for. I'm glad to have the opportunity to talk to you, and we wish everybody a great holiday and a happy New Year.
Great. Same. Bye.